Are you curious about what private equity funds and real estate syndications mean? Are you looking for a way to diversify your portfolio and potentially earn high returns? Well, in this video, we're going to explore the benefits of investing in both, plus how they're structured differently and what you can do today to get started investing. And if you're new here, I'm Dr. Jeff Anzalone, a periodontist on a mission to get you out of the rat race by creating passive streams of income. Do me a favor and download the free guide I put together just for you below the video. Now, both real estate syndication and private equity funds, they share a common purpose. They pool capital from investors in order to acquire a variety of assets such as mobile home parks, self-storage, apartments, etc. And they do this by actually leveraging the financial resources and expertise of the group. Even though they share common goals, they differ in their structure, capital raising process, and the roles played by both the general and the limited partners. So let's start off with the private equity funds first. Private equity real estate funds, they've actually been around since the 80s, and you've probably heard of some of the major ones, including Blackstone, Apollo, and the Carlyle Group. Now let's talk about how they work. First, they come together and they raise capital in advance. Okay, they raise capital in advance, creating what's called a blind pool of money that the fund manager, also known as a general partner, he or she can deploy to begin acquiring investments. Now, because it's a blind pool, the investors are actually placing their trust in the general partner to make the right decisions on their behalf and essentially buying into their philosophy, whatever that is. So the general partner is considered a fiduciary, meaning that they have a legal obligation to act in the best interest of the fund's investors and are responsible for sourcing and executing deals, managing the assets, and ultimately delivering returns to the limited partners, which is you and me. Now, because these investments are pre-funded ahead of time, the general partner can act quickly when opportunities arise, allowing them to secure deals quickly in order to outcompete others in the market. So think about it. If you had a checkbook and that checkbook was connected to a checking account with a ton of money in it, and you automatically heard about a good deal, well, you don't have to worry about going to the bank or getting financing. You could just cut a check right on the spot, getting first dibs. That is, in essence, how these people are operating. Okay, that's private equity. Now, let's move on to real estate syndications. Okay, most of these investments are very asset specific, meaning that investors pool their capital to invest in a particular property. My first syndication was an apartment complex in Dallas, and I think I got in 2017. That's already gone full cycle, meaning it's already sold. Now, in these real estate syndications, the general partner, they're still responsible for the management, but the main difference between the private equity fund and the real estate syndication is the capital is not raised until a deal is secured. As you can imagine, this can be challenging, as not only does the general partner have to find suitable investments, but then they must quickly raise the money before the project closes. And occasionally this can put the general partners in a rush to get everything done, like getting all the private placement memorandums or the legal documents signed by all the investors. Make sure all the investors have all their wires transferred, the funding transferred before the closing. Okay. Now, that could provide a little bit of stress. So let's talk about kind of how this, very briefly talk about how this process works. So you got the general partner. They're the ones that are actively investing in the group. And then you've got you and I, the limited partners. These are the passive investors. Okay. We'll just put these are active. And they come together and they form an LLC. The LLC then buys the property. Okay. Now, whenever capital is being raised, the general partners of the sponsors, what they're going to do, let me get rid of this. So let's say they have a project. Let's say it's like a mobile home park. Okay. So they've got this mobile home park that they found right here, and they're going to find it. They're going to put together all this material. Then usually they have a list, an email list. In my passive investor circle, if you're a member, if you're accredited, if you're not a member, links below this video, you have access to the deals that I invest in. So whenever these sponsors raise money, let's say for this mobile home park, what they'll do is they'll send out an email. Okay. They'll send out an email to the limited partners, to the people in their group, and then they'll host an investment webinar. And in this case, it's about the mobile home park investment. And what they'll do, they'll have something called a pitch deck, which is nothing more than a fancy brochure, so to speak. Most of these are PDFs. Most of them they'll email to you. It could be anywhere from 20 to 50 or 60 pages. It's got all the pictures of the property of the mobile home park, all the returns, all about the area. It's outlining everything about it. It's going to have their investment strategy. It's going to have the potential returns. It's going to have all the details, pictures, everything that you want to know about if you were to invest in this mobile home park. They're going to have a webinar, typically a live webinar, and they'll have some frequently asked questions, and then typically they'll have a Q&A section at the end. A lot of times, in our cases, when we hold these, we'll record these webinars because, as you know, life happens. Not everybody can make it to the live event. Then we'll take all of this will be recorded. So you'll have a recording that will be sent out via email to the passive investors. Plus, we'll take the pitch deck, also called the offering memorandum, or OM. So you'll have this offering memorandum, typically in a PDF form, which they will attach the email. So not only do you have the live webinar recording, you also have the pitch deck that you can go through if you don't want to sit through that entire recording, because that's typically all that they're doing is going over that. All right. Now, after all this is done, once the webinar is done, then what they'll start doing is they're going to start taking the soft commitments. And the soft commitments mean basically you're raising your hand. Okay, you're raising your hand going, hey, you know what? I'm interested in this. I'm not a hard commitment, meaning I'm definitely going to do this, but I'm interested enough to raise my hand, hold a spot in line. Here's the amount. Typically, the minimums on these range anywhere from I would say $50,000 to $100,000. All right. So let's say that I'm going to raise my hand and go, you know what? I'm interested in potentially investing. I'm going to make a soft commitment to $100,000 in this mobile home park. Then what you can do is start doing your due diligence. If you don't know the sponsor, you can start looking at this more, that sort of thing. All right. But again, there's typically a closing date. So all of this has to get done. So literally the race is on to get everything done within a specified time frame, because a lot of times there's a closing date, and it's usually anywhere from 4 to 6 weeks after the webinar. You got to get all this stuff done. Okay. Now, in both private equity funds and these syndications, the general partner, they're gonna earn their money by charging fees. This could include management fees, which actually compensates them for overseeing the investment, disposition fees, which are actually paid when a property is sold. Additionally, they may receive a share of the cash flow generated by the property or a share of the profits upon the sale of the asset. Now, typically the passive investors, you and me, we get what's called a preferred return, or a pref. Now, what this is actually a predetermined percentage of the profits that must be paid to the limited partners first before the general partners can receive their share. I really like this structure because it incentivizes the general partners to do well, or guess what? They don't get any cash. And they also receive, so the limited partners, they also receive a share of cash flow and the profits generated by the investment. Okay. Both the limited partners and the general partners do. Most of the syndications that I've been a part of, they've paid anywhere about a 6 to 8% pref during the whole period. So if let's say it's a 5-year hold, and let's say you're going to invest 100 grand, it's paying a 7% pref. So what that means is you're going to expect to get $7,000 a year over the 5 years. So 7 times 5. So you're expected to get $35,000 of cash flow over that 5-year hold period. And then the average is 70-30 or 80-20 split. So meaning whenever, in this case, a mobile home park, when that mobile home park sells, 70% of the profits goes to you and me, the limited partners, and 30% goes to the general partners. So it could either be 70-30 or even better, 80-20. Now, regarding both of these types of investments, there are some key differences in terms of risk and potential rewards. In the private equity fund, again, investors are placing their trust in the general partner to make a sound decision based on their behalf. Remember, they have that blind pool, and it actually could result in a more diversified portfolio and potentially lowering your risk because they may be investing in a bunch of different properties, hence the name fund. However, this also means that investors have less control over the specific investments made by the fund. On the other hand, syndications offer the opportunity to be more involved in the decision-making process. They can choose the specific deals that they wish to invest in because, again, they're having a webinar, they're explaining everything first, and then you can decide, do I want to invest in this? So again, you could provide a greater level of control and potentially higher returns if this investment is successful. However, this also means that the investor's portfolio may be less diversified, and because it's less diversified, it's only one mobile home park versus several mobile home parks. So because it's less diversified, it could be subject to a higher amount of risk. Now, I know we talked a little bit about both. My favorite is real estate syndication. So if you want to learn more about real estate syndications, I've actually gone in and put together a very comprehensive video on how this whole process works, and you can check it out over here. Hope to check you out going over here with the syndications. If you have any questions, leave a comment below that video. Take care.